Hi there, my name is Khalstian and I'm the founder of Egg Capital, where we look for market-beating stocks for the long run. To find these companies, we analyze the 5 following factors to form an opinion on whether a stock is undervalued, fair valued or overvalued. We look for high returns on capital, strong growth, healthy financials, an undervaluation and a sustainable moat. Today I will be analyzing Alphabet, but before we do, please take a moment to hit that like button and subscribe to my channel so you never miss out on any future updates and valuable content. In case you didn't know, Alphabet is the tech giant behind Google and YouTube, and through Google it dominates search and digital advertising. YouTube is the world's most viewed streaming platform and the second largest search engine. And hey, if you're watching this video right now, you're helping to keep YouTube in that top spot. Now Alphabet also continues to innovate in quantum computing, highlighted by its recent breakthrough with its chip Willow. But first of all, what is quantum computing? Quantum computing uses quantum mechanics to solve complex problems faster than on classical computers. Now that might still give you question marks, so I'm going to give you an idea of the potential of this technology. The Willow chip performed a standard benchmark computation in under 5 minutes, which would take today's fastest supercomputer over 10 septillion years. I had to look that one up. How many zeros is that? Fun fact, this number vastly exceeds the age of the universe. Now this demonstrates Alphabet's significant lead in this transformative technology, which could have profound implications for the future of AI applications. Now let's break Alphabet down into our 5 key factors. For our first key factor, we are looking for companies with high returns on capital deployed. Preferably, we would like a return on invested capital that is higher than 15%. As this gives a strong indication of financial efficiency and profitability. Now Alphabet ticks the box on this front with a 5-year average return on invested capital of 30% and a return on equity of 27%, which is a strong indicator of effective and disciplined management, reflecting their ability to generate superior returns from the capital that is entrusted to them. Next to that, we are looking for companies that are able to grow earnings whilst maintaining healthy financials. Alphabet is showing strong growth with revenues of the last 5 years growing with a compounded annual growth rate of 17% and a compounded annual growth rate for earnings per share of 26.5% for the past 5 years. This results in an impressive growth of earnings per share from $2.50 in 2019 to $7.50 for fiscal year ending 2024. However, it is of importance to understand whether this growth will continue for the foreseeable future. For the third factor, we are looking at healthy financials. Alphabet has a total debt of just shy of 29 billion and 93 billion in cash and short-term investments. This means that Alphabet can pay off its debt and have almost 64 billion left in cash and short-term investments. This confirms that Alphabet has a rock-solid balance sheet that can weather any storm in the future. It is worth noting that the cash and short-term investments have decreased in the past few years, but this is likely due to increased investments in AI and other growth areas, and is something to keep an eye on. Now for the fourth factor, we are looking for companies that are undervalued. Historically, Alphabet tends to have a higher valuation based on healthy growth prospects for the future. With a current price to earnings ratio of 25, we can say it is undervalued compared to the broader market with a PE ratio of 30 for the S&P 500, which consists of the 500 largest US firms. A rule of thumb that I have learned from the super investor Peter Lynch is that when earnings growth is higher than the price to earnings ratio, then this is a good indicator that the stock is undervalued. This appears to be the case as the compounded annual growth rate in earnings per share for Alphabet is 26.5% compared to the PE ratio of 25. A strong determinant of future growth is the moat, which is the ability of a business to maintain its competitive advantages over its competitors in order to protect its long-term profitability and market share. In this case, key competitors one can think of are Meta in the advertising space and Amazon and Microsoft in cloud solutions. Alphabet has a strong moat with its search engine dominance and advertising ecosystem. It is the largest player in the digital advertising space, with Google Ads and YouTube Ads generating the bulk of its revenue. YouTube, with its vast user base, combined with a growing focus on short-term content through YouTube Shorts and premium services such as YouTube Premium and YouTube TV, ensures continued growth and diversification. In addition, 70% of global smartphones run on Android, which is Alphabet's mobile operating system. And Google services are tightly integrated with Android, ensuring that users remain within its ecosystem. Google Cloud is not as dominant as AWS from Amazon or Azure from Microsoft, but it is growing rapidly and offering unique AI and machine learning solutions. However, there are some risks to the moat of Alphabet, such as regulatory scrutiny. Currently, there are 3 antitrust cases against Alphabet by the US Department of Justice, of which one relates to Google Search. If this results in a potential breakup of Alphabet, this could materially weaken its ecosystem. In addition, there's fierce competition in AI, with competitors such as Microsoft, OpenAI, and Meta investing aggressively in AI, which could weaken Alphabet's position in this space. Now, before we conclude on Alphabet, you may have spotted in my video that the charts that I've been using were created with the help of FinChat. If you want to take your investment analysis to the next level, then click on the link in the description box below to try out FinChat and unlock powerful tools to make smarter investment decisions. I'm advertising this tool as it is a very reliable and intuitive product, and I've been using it for years. To conclude, in my view, Alphabet is undervalued based on the 5 key factors that we discussed earlier. It is a robust tech firm with consistently high returns on capital deployed, which is also reflected in their strong growth in earnings per share for the past 5 years. The largest source of profits are from advertising revenues from Google and YouTube, which in my view will keep on growing for the foreseeable future. From a valuation perspective, the stock is undervalued, and this is most likely based on investor sentiment regarding the antitrust cases from the US Department of Justice against Alphabet. I believe the current valuation incorporates the risk of potential future impacts from the antitrust cases, but this is something that every investor will need to judge individually. It is also worth noting that the materialization of their quantum computing efforts is expected to take 1 decade before it will turn in any actual profits, as this technology does not yet have commercial applications. Alphabet has a very strong moat through economies of scale and the vast amount of data that they generate, which creates a virtuous cycle where their services become better over time. But they will need to keep pace with ongoing innovations and navigating regulatory challenges to maintain their edge. Please let me know in the comments below what your view is on the valuation of Alphabet, or if you would like me to analyze another company. Thank you for watching and see you next time.